Good morning. We have gotten to Wednesday, September 18th, and today is when the Federal Reserve is going to make a decision on rates. Are they going to move rates by 25 basis points or 50 basis points? That's going to be a key decision. They're going to make that announcement at 11 a.m. Pacific, which I believe will be 2 p.m. Eastern. And the the information will be one thing, but what I think is going to move the market even more are the comments that the Fed's going to make. And they're going to start their speech, or I should say, the chairman of the Federal Reserve is going to start his speech at 2:30 Eastern or 11:30 a.m. Pacific. In that speech, he'll talk about the economy. He'll talk about what things are concerning, and he'll, in essence, summarize what the Federal Reserve is considering for the next year to 2 years. That's what's going to move the market. As he talks about the economy and the economy condition, the health, the prospects of the economy. Is the economy gonna go into a recession, a significant one? Does he still feel confident that he can do a soft landing, which means very little unemployment, very little pain to the American population? Those are going to be the comments that move the market. If he is concerned, if he's really emphasizing that they see trouble ahead, market's going to sell off. The market's going to freak out. Tomorrow, we have employment data, unemployment data. And that combined with today's news, that's what's going to move the market, over the next 6 weeks, call it 8 weeks. If you consider that's the big economic news, the big event that's going to kind of chart our course. Are we going to go up? Are we going to go down? Are we going to go down severely? And combined with, we've got this massive election coming. The election's really taking up a lot of, I think, mind share of the American public. And I think investors are realizing that, hey, this election is very consequential. Whether it doesn't matter who you're going to vote for. To me, it doesn't matter. Either president is going to be leading the greatest country, in my opinion, in the history of capitalism. And capitalism is just such a powerful force. It creates so much value and wealth and good conditions for all Americans that leader will be guiding, I guess, the economy to some extent. But they're not a direct influence on my decision to buy more Meta or sell Meta. so I'm waiting for that to be out of the mind share of the investing community. But the reality is, for the next 2 months, we are going to be in a state of a little extra anxiety, a little extra fear, a little extra tension of the election. And that's just normal. Combined with the seasonal forces that tend to have stocks sell off in September and October, I think it's a stew that's going to be brewing to basically, I expect I'm going to wake up in mid-November and stock prices are going to be 10 to 15% lower. I could be wrong, but that's my feeling. We'll see how it happens. All right. So as we get into today, I have a list of stocks that I want to look at. But if you want to look at a stock, please let me know in the comments. We can take a look. We can take a look at the company, analyze it. I've got time today to maybe do a couple deep dives and see if companies are worth, if anything, our analysis, our additional consideration as we look at those stocks as a potential investment. And we have a couple other things that I wanted to cover. So real quick, just looking at the bond market. So the Federal Reserve makes decisions on interest rates, and most definitely that is consequential. They talk about, interest rates, they make decisions, and they certainly have an influence on interest rates. But the bond market really does set interest rates. And the bond market is a free market, just like the stock market. Who sets the price on Apple stock? Investors do. If more investors want to buy it than investors want to sell it, it goes up in price. If more investors want to sell Apple than investors that want to buy it, the price goes down. Market forces. And that's the same thing for the bond market. As investors are going into bonds and provide more demand, the price of bonds goes up and vice versa. The yield is really opposite to that. In order to attract buyers, the yield has to go up. And what we're seeing today is that yields are going up. And to me, it's a sign that I'd probably be leaning that it's going to be a 25% basis point change today because rates are rising. Rates are rising right now. It's 6 a.m. Pacific, and we're seeing interest rates rise. The 10-year is the most referred to interest rate based on the U.S. Treasury. The 10-year tends to drive mortgages, a lot of auto loans, a lot of things are pegging that particular rate and that yield. Rates are rising. Now, that makes buying bonds for me attractive. I bought $2,000 of bonds yesterday in a bond issued out by General Motors, and I'm probably going to buy $2,000 of bonds today. I tend to buy on days when rates go up like this because I get a better yield and I lock in that yield. The bond I bought yesterday was a 5-year bond, which means that I'll earn the interest rate that is defined in my purchase for 5 years. Over time, I think interest rates are going to drop. I think we're probably going to be sitting a year from now, maybe 2 years from now. Interest rates are a full 100 basis points or 1 full percentage lower. And therefore, I want to lock in my bond yields as I see rates creep up, lock them in because I expect over the next couple of years, they're going to be far lower. So the bond market's telling us, at least the bond market is feeling that the Fed is only going to go 25 basis points. We'll see what happens. We'll see what happens. So the market, stock market right now, the futures are up slightly. Now, you guys probably noticed yesterday that the market kind of gave us a nice head fake. It went up. It was looking good. Some markets were rallying more than others, and then it came down. So that was interesting, but not a giant surprise. This week is it's a week where you gotta take a little stress. There's some moving parts this week. We're not quite sure where we're going to end up at the end of the week. So the market to go up and down in a single day like it did, that kind of was expected. What are we going to do today, right? I don't know that this morning, up until the Federal Reserve begins to share comments and answer questions of journalists, the market's not going to go much higher, much lower. It might have a modest gain, might have a modest loss, but the fireworks are going to go off in the last hour of trading. Last hour of trading is going to have comments from the Fed priced in. And let me tell you, get the popcorn out because this is a day when stock investing gets really interesting. This is almost like, in a football game, the fourth quarter, it's a tied game and you have 5 minutes left on the clock and you're trying to see which team is really going to drive down the field and score the winning touchdown or field goal. It's really going to be interesting. So today and tomorrow, it'll be somewhat easy to know what's going on because the unemployment data will be released before the market opens. If we have a bad report, unemployment's really going up, it's going to sell off. It's going to sell off quite quickly, probably continue into Friday. If the report's good, it might have a little rally tomorrow. So we'll see how it happens. Looks like we've got Android PC gameplay online. Hey, what do you think about the new Intel partnership, the partnership with Amazon? I think it's really positive for Intel. And boy, they really needed something like that. And I think it's smart that Amazon is looking for compute and high performance computing capacity outside the NVIDIA kind of technology. And the reason for that is Amazon's, the biggest hyperscaler on earth. They're the biggest cloud on earth. And if they can find a way to lessen the cost and make it more efficient, they're going to get that further ahead. So it's smart for Amazon. They're probably going into the Intel partnership with Intel really catering to everything Amazon wants because they're kind of desperate. They need a partnership like this. So it's good for both sides. It's very good for Intel. They needed some good news. Holy smokes. The last 3 months for Intel have just been horrible. I don't know. They couldn't have done much more wrong, or things couldn't have gotten much worse for them over the last 3 months. So it's good news for Intel. And they still have really terrible financials. If you look at their financials, let's take a look at Intel, and I'll show you what I'm talking about. And I don't want to lose this browser, so I'm going to start another one so we can take a look at Intel. And I could point to some things in the financials that I don't like. So you see a lot of red negative growth, right? And we look at the quarterly. They were supposed to be coming out of the doldrums of the PC slowdown, and then they hit, negative growth. In addition, they had these massive write-offs that drove their profit down. So this was a big part. They pre-announced layoffs, so they were taking a expense that they're going to expect for all the severance packages and stuff they're going to need to do. So their income really went down. Their earnings per share really went down. Cash flow wise, their free cash flow is in the negative. I mean, this historically, Intel, right? I've been analyzing Intel for 20 years, and for a long time, they were just such a desirable company. They generated great free cash flows. To see Intel this low with regards to performance is quite disappointing and kind of sad to see such a great company get this low. So their financials are terrible. The news was good. I hope that they can build on that good news and kind of rebuild their business and kind of get back to being a good company, because they have a lot of employees. It's a storied company. I want them to do well. But for now, their financials are just terrible. So I'm staying away from Intel. Maybe eventually I might come back, but there's so many options in semiconductor. I'm getting into Qualcomm right now. Qualcomm is different than Intel, but I think provides a very good proposition to investors. The company, if you look at their revenue growth, is growing. Nice green. They had a slowdown, and I'm looking at the quarterly, but let's look at the annual. So you saw the quarterly, they're growing in those quarters. So they had a slowdown, but they're now growing in the quarterly. They're growing quite nicely, 11% in the most recent quarter. That's excellent. So this is the semiconductor company that I really like. Qualcomm continues to generate free cash flows. They really have a good proposition for me. So I've started to buy into Qualcomm. I could see myself buying $50,000 of Qualcomm right now. I think I'm at just a couple $1,000. Qualcomm, I've invested $3,000. I've got a 5% performance or appreciation going. They pay an okay dividend. I think their dividend is 2%, and I think dividends are really beginning to go down from a percentage perspective because stock prices have been going up. And the calculation of dividend is, how much the dollar amount is divided by the share price. So if that share price keeps going up, the dividend percentage keeps going down. So Intel, I think, is a sick puppy. I don't know when it's going to get healthy. And I'm buying into Qualcomm. I think it's a good time to buy Qualcomm. They're on the rise, and I'll continue to buy shares. Hopefully I can build up a nice position, but I'm not going to be in a hurry. As mentioned, I would not be surprised if stock prices are 10, 15% lower in 2 months. And we'll see how things play out. Looks like Alta is online. How are you? What do you think about Keurig? Keurig, sorry. Keurig is a coffee brand, and I own a Keurig. Sorry, I drink Keurig. So Keurig, I've never looked at that stock. Let's take a look at that. So PPRUY. Hopefully, I have access to it. And then Guess. I have looked at Guess, and Guess, I'm going to give you. Every time I look at Guess, it's a valuable company. I think I could show you a discount. I'm just not comfortable in that space. I'm not a luxury guy. I'm not a fashion and apparel guy. So it doesn't make total sense to me. So one of the rules that I follow is I only invest in something that makes sense to me and I could rationalize. But let's look at it, because you may have a better eye for fashion and a greater appreciation for Guess. I'll show you the numbers, and I'm probably going to arrive at, hey, this company has really strong fundamentals, which is last time I looked at them, that was the case. So let's take a look. Then Android PC, Intel and MU are the only, I guess, cheapish semiconductor company at this time. I think we'll hold. Holding Intel is not a bad idea right now. I mean, that news was big. I mean, you're partnering with Amazon, which is probably the biggest consumer of semiconductors, as a single customer, really in the world. I can't think of anybody who could be bigger. And Amazon's also growing their cloud business. So, and the PC business is bouncing back. I own Hewlett Packard, the PC company, and they're growing their revenues. They're seeing PC sales go up, and Intel has 80% of the PC market. So, holding Intel is not a bad move. I don't own Intel, but I can understand that plan. Let me finish my thought on a couple of opening comments, and then we're going to get to Alta's request. Take a look at those two companies. Then I've got a couple other companies that I want to look at. I wanted to go over one stock that I've decided to sell. I wanted to go through my train of thought. Sometimes deciding to sell a stock is like a lot harder than deciding to buy a stock. Sometimes we see a stock, we think it's discounted. There's good reasons to own the stock and own it for a long time. Well, at what point do you decide to sell a stock? So I'll go through my rationale and my plan to sell one stock that I'll announce in a little bit. Steve 90. Hello, Victor. Do you prefer Qualcomm over TSMC? Yes, I prefer Qualcomm over TSMC. I think TSMC, and I'll show that to you. I'm going to look at TSMC after Guess, and I'll show you that I believe TSMC is being priced at a pretty steep premium. And I'll compare it to Qualcomm, and I'll take you through my rationale and to give you a preview. I owned TSMC for 3 years. I made a lot of money on TSMC. I sold TSMC a number of years ago. I know the company, and I know the company, I think, well enough to invest in it and evaluate it, and I'll share that with you. Alta, laugh out loud. You're laughing at me because I don't know fashion and apparel. I'm going to stay in my lane. I know some things, but not fashion. So, Mike, what's up, Mike? Good to see you. Find it hard to sell a stock as well. FOMO. Yeah, let's talk about that, because I'm really glad that we talked to Prad yesterday. I talked to Prad yesterday. He's a trader. And I think that a lesson that I'm taking out of it is that, there's two extremes, right? There's the extreme of an investor that buys in one day, or in his case, he might short a position that he believes, hey, this company's, priced too high and it's going to go down just in this day. And then that person realizes a gain or a loss. There's a lot of accountability there. There's a lot of, this is what I think, execute a trade, close out the trade, and then measure performance. The feedback loop is immediate. You can't get it more immediate than that. Now, the other extreme is hold forever. Well, that doesn't have a lot of accountability, and you can't really truly measure performance. You can measure unrealized gains, right? But until you push the sell button, you did not realize that gain. And then that's really when you ring the cash register and you can really measure performance. So I like interacting with Pratt. I hope to do that again because I too want to become better at selling. I don't know that I'm strong at it because in some cases, I probably sell too late or I seldom sell too early. So I'm going to go through my rationale on one stock, and it is a stock that I'm making money on. It's a good stock. It's something that I got right, but there's reasons behind it that I want to follow. There's principles, I should say, that I want to follow. I'll take you through that. All right. And then Jackson. How do I like CVX at the current price? I do like Chevron at the current price. We've talked about oil. We've been talking about oil for 2 weeks. Oil prices went down, and then oil prices went up. So if we look at oil prices, it is a commodity. We saw it go down quite a bit, and then it rose. Over the last 5 years, I would say, so you can't really put COVID in the picture because COVID was an unnatural, I guess it's a natural event because it's a pandemic, but it only happens every 100 years. So in 100 years, that's going to happen again. Now, all joking aside, I think that if we, especially if we look at the max, oil price for the last 10, 15 years, we've been at times quite a bit higher on oil price. And as the world continues to modernize, like there's some countries that are building out their middle class and they're buying cars, gas burning cars. There's more demand on oil. And I think that the oil price at the current, oil price is probably a little low. And if we were to go up maybe to $70 a share, that really does mean more cash flow for Chevron and other oil companies. So I'm glad that, we're talking about oil companies because, I'm a Chevron stockholder. I'm not buying any more shares because I own over $100,000 of it. And that's enough. But it's not a bad idea to buy something when it's low and then watch it rise in value when the commodity price probably gets back to a more normal price, which I would say is around $70, $75 per barrel. And if we have some type of supply issue, like a country, an oil producing country has problem with their production, or you have some type of tension in the world, that oil price can really get up to $80, $90 per barrel. So we'll see. All right. So we talked about, I wanted to go over one more topic and then we're off to the races looking at some stocks. Just looking at sectors yesterday, we just talked about oil. Energy led the day yesterday, appreciating the most. And it's good that, so as a community, right, it's good that we talk about something ahead of it beginning to rise. Because then, we're all getting better. It's like, hey, watch something when it's unappreciated, price too low, and then watch it rise when it gets more appreciated. So energy's been on a nice little run. So we'll see how long this lasts, and we'll see if oil prices keep rising. But energy was the best sector yesterday. Consumer discretionary did well. Industrials. What did the worst was healthcare. I'm not sure why. I'm not going to try to explain it. Staples went down, and I'm thinking staples are going down because I guess yesterday investors felt that the economy is not going to be a big issue. Now, if the Fed reduces or rates by 25 basis points, and it's consistent with the economy isn't doing all that bad. We're not in big economic trouble. So that story is kind of holding a lot of water. If I had to bet $1 on what I think the Fed's going to do, I think they're going to move 25 basis points. That's my feeling, and I could be wrong. Most definitely, I'll know if I was wrong in 6-7 hours. But the market, when you see staples move like they did, the market's also thinking, okay, we don't have a bad recession coming, so we'll see. Real estate was a laggard, and then technology was a slight laggard. So I know that Apple's had a couple bad days. The worst day being, I think it was Monday when it had its worst day. Yesterday, I think it was close to even, so not a bad day. So that's what happened on the sectors. All right, so let's take a look at PPRUY. So this company, never heard of it. Let me get acquainted with it. So Caring SA manages the development of a series of renowned houses in fashion, leather, goods, jewelry in France. Okay. And the company offers ready-to-wear products, apparel, accessories for men and women. It all offers leather goods and shoes, watches, jewelry, eyewear, fragrances, cosmetics. The company provides Gucci, Saint Laurent, Bottega Veneta. All right. Okay, so this company is in Europe. Again, I'm going to just share that this isn't a space that I'm good at. I don't get fashion. I buy stuff that looks okay, and I usually, I don't buy cheap stuff, but I'm not big into like, hey, I got a $500 shirt. That's not me. I'd rather buy a nice stock. So let's get into the fundamentals. Somebody else may be like totally into fashion. Let's see if this company, just looking at fundamentals, makes sense from a discount perspective. Is a stock discounted based on their free cash flows as well as the earnings per share they produce? So this is a $31 billion company. It's in US dollars. Their revenue is $19.7 billion. Okay. Earnings per share is $18. Wonder why they can't provide a PE ratio. Interesting. The dividend is nice. Just be careful on foreign stocks. Sometimes the dividend is listed as such, but there might be a foreign tax that the country where they operate would charge the investor that's outside country a tax before you get your dividend. So just be aware of that. The revenue, top line revenue tells me the growth tells me the business is healthy. Are they growing? Do customers like their products? Therefore, they're going to buy more of the product, and they're actually attracting more, net new customers. And in this case here, for the trailing 12 months, revenue is down 10%. So that is a concern. And they do semi-annual because companies in Europe will issue out financials twice a year, where in the US, we issue out financials 4 times a year, every quarter. So that's a big concern. Okay. I don't like seeing revenue go down. This is fashion. This is consistent with a slowing economy. Consumers don't have as much discretionary income, so they're not buying that extra Gucci item or whatever other great brand they have. So that's a concern. How long is this downturn in revenue going to last for the company? That would be interesting to know. From a cash flow perspective, looking at the trailing 12 months, their free cash flow is, call it $2.2 billion. And they have produced free cash flow for some time. I think a big part of why they produce free cash flow is this is a premium product company, and they're probably their material cost, kind of like their prime cost of their products, are probably well below the sale price. And they have a premium brand. I think consumers appreciate that premium brand. They pay up for it. And the company gets to keep a lot of that price in the form of cash. So that's good. It's a good, productive business. So this company is not growing. So it's hard to give them what I call a multiple on cash to get to kind of a quick ratio of is the company discounted or not discounted. So I would actually go about 15 because they did have historic growth. And if I do that, they'd be priced at around $33 billion, which is roughly around where they're priced today. So I wouldn't consider this is a highly discounted stock. And the other concern I would have is if we do go into a recession, and I don't know how the recession's playing out in Europe or globally, this company is probably going to struggle further on their top line revenue. And the perception of this industry is also going to come down. And therefore, stock prices are probably going to go down for a company like this. So I think it's either fairly priced with not a huge prospect for the future. If we look at 5 years, the stock's actually not performed very well for the last 5 years. You would have lost 48%. So that's not good. The stock has been sold off. Now, it's not the right investment for me. Again, I started off by saying these companies, they don't make sense to me, so I don't invest in them. But the fundamentals are not screaming that, hey, this thing's discounted by 50% or 75%. It's misunderstood. To the right investor, it could really deliver great returns. I'm not seeing that. I'm actually seeing that, if anything, they're fairly priced, and we're going into potentially a recession, which may be an additional headwind or additional struggle for a company like this that sells premium products. So thanks for asking. You took me into a zone that I don't really go into all that often. Let's talk about Guess, which I am familiar with. Guess is, I believe, headquartered in Los Angeles, and I'm not too far from Los Angeles. So I've known of this company for a long time. And most definitely, this isn't like a Gucci, super expensive brand. Guess is very accessible to the consumer. I've owned some Guess products, and I think they create nice fashion. They are a 1 billion market cap company. So this is a small cap. Interesting. Dividend looks really nice. If you look at the 5-year, it's really done okay, but that's not even okay in my book. I like to see a company double in value over 5 years. Now, past performance is not indicative of future performance, but I just wanted to show that. In the last year, it's down 11%. So are we dealing with a company that's discounted? Let's take a close look. Analysts think it's heavily discounted. It's discounted by 46%. Wow, it's pretty good. So from a trailing 12 months, the company has revenue growth of 6.75. That's pretty good. And in the most recent quarter, it's 10%. That's very good. They've had a consistent growth rate since 2022. They had a bad year in 21. I don't know if I'd want to know what happened. Like, why did they go down 29%? That would be a good homework item for whomever is interested in this stock. Now, so the top line's growing. That means people like Guess products enough that they buy more, or maybe more customers are coming to the Guess brand and becoming customers for the first time. When we look at their free cash flow, they cash flow at $224 million a year. All right. And they have had free cash flow for the last 5 years, which is very good. They are a growing business in fashion. And at a minimum, I multiply that times 10, which gets us to a market cap value of like $2.2 billion. So this stock is discounted. And that would be in the neighborhood of a 50% discount on Guess stock. Let's look at the balance sheet. Maybe the balance sheet's got some trouble that we got to look into. They have like $218 million of cash and short-term investments. Their total debt is 1.4 billion. So it's about 1.2 billion in net debt. How much is their EBITDA? How quickly can they pay off all that debt if they wanted to? They do about 300 million in EBITDA. So it'd take them 4 years, which is above the ratio I like seeing. I would be more comfortable if they could pay off all their debt using EBITDA in less than 3 years. So the balance sheet is riskier. It is a risk item. Now, to the investor that really understands fashion, understands where Guess is in the marketplace, and believes that, hey, they're going to keep growing because they came out with this one product, or consumers love the brand because of this or that, more power to you. I think you have fundamentals to work with. You got to keep an eye on that balance sheet. That balance sheet is riskier. I wouldn't buy a balance sheet at 4 times EBITDA. It's just, it's too risky. Good quality businesses don't have to carry that much debt. So it's kind of a symptom of a bigger problem that exists within the company. And they generate a lot of cash. So I don't get why they wouldn't just pay off that debt. Maybe reduce the dividend for a little while and pay off that debt. But that's the decision they'll have to make. So Guess fundamentals look interesting. It looks like a discounted stock with a risky balance sheet. To the right investor in that space, good luck with it. I hope you find something that's interesting for you. Thanks for asking on Guess. And what I'll do is I'll turn my attention to TSM, which is Taiwan Semiconductor. And what they did, which was really smart, was a long time ago, the Taiwanese, I would say the government and some investors said, hey, let's create the biggest foundry on the planet. And they basically turned Taiwan into the highest producing semiconductor country in, I think, the world. And then TSM's now beginning to build foundries in other parts of the world, including the US. I think they're going to build one in Phoenix. Now, it was a brilliant idea because the semiconductor space had this change in, I would say, strategy. Companies like Broadcom and other companies came out as fabless semiconductor companies. And what that meant, NVIDIA is fabless. What that means is those companies, they wanted to control the design of the chips. They wanted to control the intellectual property that was created and then put into those chips. But they didn't want to own the foundries. The foundries are where you actually manufacture the semiconductors. Traditional companies like Intel, they owned, call it the whole process from design, foundry, distribution. Like they were completely vertically integrated to be a semiconductor company. And as companies thought to themselves, like, it takes a lot of capital and know-how to operate foundries. We don't want to be good at that. We want to be good at designing chips that are really needed for whatever compute and workloads were needed. For example, when smartphones came out, we needed more chips for smartphones, and companies like Qualcomm, Broadcom, and others really flourished. So that's a quick crash course on the semiconductor industry. And TSM benefited from that big change in the industry where they were like, hey, we'll be the foundry to the world. And they became really, really successful, and their revenues grew really, really well. If we look at them traditionally, it really is an awesome company. I'm going to go back 5 years and show you, like, over the last 5 years, it's done 281%, a lot of it more recently. And I started investing way back here. So I was able to get out of the stock around here. And I got out. This was like a 3-bagger for me. Awesome. Thank you, Taiwan Semiconductor. I sold it. And then it had some tough times along with everybody else in 2022. And it was a really good buy. Now, I would say that it was a really good buy, but it's really gotten overheated because of the whole AI hype and the data center kind of expectation that data centers are just going to be huge. So you think about that and you go, okay, for the last year, this stock's gone up 88%. Okay. So I would expect their financials are going to show really good revenue growth and really prosperous business. So let's take a look. What we actually see is in 23, they had a loss of sales. And then the trailing 12 months, they have bounced back. So they have seen a 40% increase in revenue. But again, we had some bad quarters here. So why was the stock rallying so much? Now, overall, when we look at the company, so they have growth now, but not incredible growth. It is a big company. This is in the Taiwanese currency. We're just going to look at ratios here. And in order to be able to put it in dollar terms, I'm going to do a quick currency translation on another monitor that I have here. So when we look at the Taiwanese currency, it's basically 3 cents on a dollar. So when we look at something, we'll try to think along those lines. So when we look at cash flow, and again, this would have to be converted because this is in the Taiwanese currency. So free cash flow, they've been a good free cash flow producing company. When we look at 719, again, we multiply times, 0.031. That's going to end up being about, so 10% would be 70 billion. It's going to be about 2 billion, I believe. And let me do the conversion real quick on another monitor. So 719, 690. So it'd be 22.5, and let me double check something. So this is in millions. Okay, so that'd be millions. So it'd be $22.5 billion of free cash flow in the trailing 12 months. So it's kind of modestly growing now. So I'd probably say, hey, let's multiply it times 20. That would give us a market cap of $450 billion, which is a big market cap. But they're being priced at like $764 billion in market cap. I actually have a full evaluation of TSM. Let's take a look at that. And I'll show you where I arrive with this stock. So when I look at TSM, and am I getting there? Oh, I guess I don't have TSM. I thought I had TSM in here. No, I don't have. Sorry. So I don't follow it because I think it's overpriced. I think it's overpriced by a pretty good margin. I think earnings per share can get you to a pretty strong stock price, but I really depend on free cash flows. As I've been studying like Pat Dorsey, which is a super investor that I really respect, and he's been very successful. Free cash flows. Free cash flows are the ideal test to see if a company is very profitable and generates value for stockholders. So I use free cash flow as the primary valuation method. And when I do that, I fall short of that $763 billion market cap that has gone up close to 90% over the past year. It's almost doubled over the past year. So I guess a year ago, it might have valued around the value that I would get for the company maybe a year ago. And now I think the expectation that semiconductor companies are going to grow really fast is there. One thing I would put out there is semiconductor is cyclical. A lot of people forget that, but it's not smooth and to the right revenue growth for companies. They tend to be up, down over time. So that is TSM. I think the question was asked, do I prefer Qualcomm over TSM? The answer is yes. Two different types of companies. Qualcomm is, I believe, a fully integrated semiconductor company where they control most of their production as well. but they do quite well, and it's a really reasonable valued company. So I'm going to stick to Qualcomm. Thanks for the question on that, and hopefully you guys found that talk track interesting. All right, so moving along. So Alta, I guess your Guess is popular with teenagers. Guess is popular with teenagers today, and they sell it on Amazon. It's accessible, not too expensive. Yeah, I agree. So Nike and Converse, yeah. I own Nike. I'm very optimistic about Nike. I think they've got a very strong brand, and I'm glad to see that younger people appreciate Nike. That's not a big surprise. Converse making a comeback. Converse is not as big as Nike, but it's making a comeback. I think Guess is not in my wheelhouse, and for all I know, that stock's going to do really well, or if it's going to stay in its kind of current state. I couldn't share that. But let's talk about Lululemon. It looks like you want to talk about Lululemon. So Lululemon is a super, I think it's Lulu, right? Yeah. So talk about a company that really created a whole new category in fashion, right? The leggings for ladies. I mean, my wife's she's a big Lulu fan. She likes leggings because I think they're really comfortable, and she looks great in them. So that's awesome. And I think most definitely this has been such an exciting category for, I guess, for the last 20 years or so. And Lululemon really created something. Over the last 5 years, this stock price really worked for a long time, but more recently, it's really down. Now, I like looking at companies that really had a big advantage. They got that big advantage by creating products that were just highly desirable, and to the point where they out operated their competition. In this case here, they came out with a product that really fit the times, right? Yoga and athleticism and healthy and comfort, and all those things are there for Lululemon. So I'm this one here, I don't have to be a fashion expert to observe the obvious, which is this is a leading brand in ladies apparel. So let's take a closer look at fundamentals. It's been a little while since I've looked at Lulu. The market cap is 33 billion, not too bad, and their revenue is 10 billion. I'd be very curious to see how their revenue growth has been. Their PE is pretty reasonable at 20, forward PE of 18. And analysts do think it's discounted. So let's look at the revenue. Now, to my surprise, they're still growing. Man, that's really good growth. So very good growth, because they're already a pretty good sized company, right? You're a $10 billion company selling women's fashion, primarily athletic, accessories. That's really impressive. Let's look at their profitability real quick. So their gross profit is really high, 5.8 billion on a $10 billion number. So that's roughly 58% gross profit on that revenue. That's very good. So apparel tends to be that way, especially the premium apparel like this company. Free cash flow, 1.7 billion. I would multiply that times 20, and I could go a little higher, maybe to 25, because this is a premium brand. I really like their brand. So that would get us to about, so we got free cash flows 1.7. That would get us to 34 to 40 billion in market cap. So this stock is right there, right? Slightly discounted, or maybe discounted a little more, depending on what growth we expect in the company. And if we look at the balance sheet, let's take a look at their cash positions, 1.6 billion, and long-term debt, total debt is 1.4. So they could almost pay for all their debts immediately. So you see there's a big difference between Lulu and Guess. Guess it would take them like 4 years using their EBITDA to pay off debt. Lulu can almost immediately pay it off if needed. Not that they do. So we looked at cash flow, so we're good there. When we look at the forecast that analysts have on this company, 30 analysts cover the company. So one of the things about picking out companies that are very recognizable and well known is those stocks tend to do something. Like back to Guess, which I think is a good comparison. I don't know that Guess is a very well-known brand to everybody. I happen to know of it because I'm in Los Angeles. When I was a youngster, I did buy a couple Guess products and saw them in the marketplace. But I don't know that the typical investor really knows Guess. But I would say everybody knows Lulu. Everybody knows Lululemon. It's a pretty hot product. And I would say 10 years ago, they were kings of the world in, athletic fashion for ladies. And if you look at the earnings per share, this year they're going to do $12 per share, and it's going to grow nicely over time. So earnings per share look good. So Lulu is looking pretty good. Now, I'm an investor in Nike. I'm continue to buy shares in Nike. So I'm good in this category. But I would say Lulu is looking pretty good overall. It's smaller than Nike. And Nike, to me, is really well discounted. And that is not the one that I want. I just want Nike. Thank you very much. We could see that Nike, over the last 5 years, the stock's really just been sold off. And that's one of the reasons I'm buying into it is this is Nike, for Pete's sake. This is a $121 billion revenue company. We just looked at Lulu. They're at $10 billion. And Nike is trying to move into Lulu's turf because they do sell leggings. They do athletic fashion. And this company, right, you would think that with the stock price going down the way it's been is that they're losing a lot of revenue, but they're not. They're holding their revenue. Their revenue is $51 billion in the trailing 12 months. So they're, 51 billion. And the market cap is, I read this wrong, 51 billion revenue, Lulu's 10 billion, and the market cap is 121. So overall, I like this investment. I think this is most definitely a brand that there's no hesitation from the consumer. Like, you need a pair of shoes and Nike is an option. It's a very comfortable, easy decision for you to make. And as well as their fashion, right? Who doesn't like Nike? So, but I like Lulu. And I would say that, this is looking pretty good as well. And these fashion stocks are, I guess, I don't put this one into like the luxurious fashion kind of category. It's more of like really a lot of consumers like Lulu. They probably buy their products for a long time, continue to buy them. And Lulu can probably expand into related products, that they can use their brand and maybe sell a more broader category of products. We'll see. I think it's an interesting company. All right, so let's take a peek at the stock market, see what is going on with the stock market. We are through the futures zone, and we are looking at a flat market. The Dow is down a little bit. The S&P is flat to the green just slightly, and then the NASDAQ's up a little bit. Probably the NASDAQ's recovering some losses from yesterday. We look at Bitcoin. Bitcoin's had a couple nice days, but overall, like I was referring to here, they had, I guess, a couple nice 2 days, but Bitcoins have been getting sold off. And I think for me, it means that the market's a little scared. There's a little extra fear, anxiety in the market, and we're not going to get through that for another couple months. After this election's over, I think the fear index is going to go down quite a bit. So stock market's flat, and we'll see how it behaves for the rest of the day. All right, so we got through all the stocks we wanted to cover. Let me kind of end with my decision to sell one stock, and I'll kind of go through the logic of why I'm going to sell it. And the stock is Zim. So Zim is a stock that has two stories. The first story is it really did well during the supply chain issues, and then the stock was really sold off. I bought it, and I'm sitting on a nice gain. I bought it at the right time within the last year. You could see that the buying was really good, and mission accomplished for me. Now, part of my intent in selling Zim is that I want my portfolio to be more concentrated. I'm going to take a 52% gain on Zim, and I've owned it for about 6 months, maybe 7, 8 months. So that's going to be a really nice return. I invested $18,000 and it's worth $27,600. I'm going to execute this trade probably in a half hour, maybe an hour. And I'm really glad that I bought Zim, but exiting a position like this, I knew this was always going to be like maybe a 1-2 year hold and then get out. And I'm ready to get out. I think the economy is worrying me a bit, and I'm not quite sure that we're going to have a prosperous economy to support all the shipping that this company provides. Now, just because I'm selling the stock, there's no rule that says I can't come back and buy it in 6 months, a year, 2 years. If the situation changes, I'll continue to watch the stock, and I'll continue to be a fan of the company. I'm really glad to see that the company did really well to continue to operate their business, show profitability, and really surprise a lot of investors, including a lot of short sellers. So that is a stock that I'm selling. I almost sold it yesterday. I wanted to sleep on it. I slept on it. And I woke up thinking I should sell Zim. Mission accomplished. Take the gain and keep it on the watch list. But I'd like to concentrate my portfolio a little further, and I'll keep an eye on Zim in the future. So that is the one stock that I decided to sell. And I kind of go through that process with stocks and see at what point should I be exiting a position. There's some stocks that I hold for a long time, like Meta. I don't know that I'm going to sell it in the next 5 years. Maybe I wake up 4 years from now and Meta's changed their business to the negative. Maybe I would sell it. Google, same thing. Uber, I'm really excited about. Those types of stocks, I'm good to hold them. I'm a long-term holder in those. So that is the one stock that I'll be selling, and I'll probably share the results of it on a video just to share how I made the decision to buy it, how I made the decision to sell it, what the gain was. So I'll go through that. All right. So good session. Again, this is the calm before the storm. The Federal Reserve they met yesterday and they've been meeting today. And at 11 Pacific, they'll announce, what the rate cut's going to be. And we'll see if it's 25 basis points or 50. And I'm thinking it's 25. I'll see if I'm right or wrong. And then the comments really are going to be what moves the market. That's what's going to be really driving the market down, potentially causing a rally. I think the downside could be far more severe than the potential upside. I think we can be down 1% on the NASDAQ today. We can be down more than that. If he says certain things that cause concern about the economy and growth. And tomorrow, the employment data, that's going to really drive the market tomorrow, combined with today's news. So everybody, thanks for tuning in. I will be live streaming each morning, 6 a.m. Pacific, 9 a.m. Eastern. And I'll try to join other streams as well, and provide other streams, maybe in the afternoon, evening. If things get really crazy today, I could totally live stream tonight. We'll see how it goes. And tomorrow as well. If the markets are really crashing or moving up, I like streaming just to review it, because I'm definitely a fan of days like this, and I wanted to share that with you guys. Overall, I'm building a community with everybody who attends the live streams and watches the videos. I'd really appreciate if you could be a community member. Check out the YouTube page. Consider becoming a paid member. I think I could recover some of the costs that I put into the videos and streams. I'd appreciate that very much, but not mandatory. I will be providing additional benefits to those members in the form of some of the tools you see me use. I'm going to provide access to those members just as a thank you for their support. And it'll also encourage other people to maybe become members. The model I showed, I'm giving access to those members as well as other things, and a little more access to those investors as we collaborate and kind of share knowledge with one another. So that's the stream for today. Everybody, let's see what happens. It's going to be an interesting day, and we'll see where we end up at the end of trading today. Everybody, enjoy your Wednesday. Thank you so much for tuning in.